In this video, we're going to use an example of a small home-based business called GeezBics to illustrate the differences in interpretation between accounting and economics of costs and profits. When talking about costs, economists concentrate on opportunity costs. Opportunity costs are central to economics. And as we saw earlier, the opportunity cost of resource use is the cost in terms of foregone alternatives. So for instance, the cost for me of making this video is the lost opportunity of doing something else, spending time with my family, watching TV, writing a book, starting to write a book or something like that, doing some research. And economic costs for economists are split into costs that can be measured. These are called explicit costs. They're generally monetary payments to, when it comes to a business, to the owners of the resources that are used in that business. But economists also will include implicit costs, and these are estimated payments that the resource could earn in its next best alternative employment. So some of those resources are not measurable, but they are of course implicit. Now, an important implicit cost used in economics is the concept of normal profits. Normal profits are the return to the entrepreneur, and these are a minimum payment that keeps the entrepreneur doing what he's doing in the particular line of business. So for instance, he's taking risk, he's organizing, he's got the ideas, he's managing the business, etc. And he expects to make a normal profit, which is seen as an implicit cost of a business. Now, accountants only take explicit costs away from revenues to arrive at profit, whereas economists measure economic or pure profit as opposed to just normal profits by taking the difference between total revenue and opportunity cost of all inputs. So why do economists make this distinction? Well, as we know, economists are interested in the reasons why resources are allocated to alternative uses. And of course, opportunity cost is extremely important there. Whereas accountants generally are interested in such things as balance sheet, compiling balance sheets for businesses so as to report on profits for their shareholders, or trying to calculate the tax return figures so as to pay their taxes. So the objective of economists and accountants is quite different in measuring costs and profits. Now, in order to illustrate these, let's choose a very simple example, which I'm calling GeezBics. Now, this is a little business that I imagine I could run. It involves baking homemade biscuits from a recipe which my mother handed down to me. And I make them at crack of dawn before I go off to the office, let's say. I'm a bit conscious of health regulations, so I can't use my own kitchen oven. But my brother happens to be a baker, so I use his oven to bake these biscuits. And of course, I have to sell them in packages and purchase the ingredients. And all those sorts of things. I have to cart them to the office. I have to go around buying the ingredients, and all these things imply a cost to me. And let's say I have about 100 guaranteed customers a week, and I sell each packet at $5 a packet. Now let's say this is a spreadsheet that an accountant may draw up to illustrate the revenues, costs and profits in this business. So the revenue is quite easy to calculate because you've got $5 and you sell 100 packets of biscuits, that's $500. The explicit cost for 100 biscuit packets, take the ingredients into account, let's say that's $100. Pay my brother, let's say, a nominal $30 for the use of his space in his oven for that 100 packets. And let's say the packaging and printing costs $15. And so if we add these up, we get $145, which appears to give us an accountant's version of profits equal to $355. Now notice we haven't included all sorts of other implicit costs. That's only done when we calculate things like an economist would. So here we have the revenues that are identical, $500. The explicit costs are exactly the same. But of course, if we were trying to replicate this business with someone else as the entrepreneur who's not prepared, let's say, to do the actual baking, doesn't have a brother and so on, they'd have to pay a baker wages for that number of packets of biscuits. They'd also have to incur some cost in purchasing and distributing the biscuits, purchasing ingredients and distributing the biscuits. They'd probably have to rent some space. They'd have to maybe lease a vehicle. And the entrepreneur, the purchaser of the business, would expect some return for their own entrepreneurial efforts. So if we add up these implicit costs of this little business, they add up to $350. And if we add $145 to $350, we get $495, and taking away all explicit and implicit costs from revenues, we arrive at a much smaller profit, $5 in this case. Now let's put this into a diagrammatic form to make it even more clear. Here this box represents the total revenue going to the business, which would be the case for both economists and accountants. If we take just the accounting view of the business, accounting costs we saw were $145, and accounting profits would be $355. The difference between 500 and costs, revenues minus costs, gives us accounting profits equals to 355. From the economist's viewpoint, the explicit costs are the same as the accounting costs, 145, but the implicit costs are quite different because there's foregone wages, there's interest, rest and profits and all kinds of other implicit costs, plus normal profits, the return to the entrepreneur, and we saw that these were equal to $350. If we add together all these opportunity costs, in other words, the explicit and the implicit costs, we get to $495. That's $350 plus $145, which leaves normal profits, economic profits, because normal profits are the return to the entrepreneur, but economic profits of $5, namely 500 minus all costs is equal to $5. So these are sometimes called supernormal profits or pure profits, but they are quite different from accounting profits. So, in summary then, accounting profit is total revenue minus explicit costs only. Economic profit is total revenue minus all opportunity costs. That's implicit and explicit. And remember that implicit costs also imply a return to the entrepreneur for managing and taking the risk in the business.